Now, this video may appeal to some traders who want a more simple approach to trading. And no, you don't need 117 different indicators on your charts to trade. Some of the best traders I've ever seen actually have used one indicator, and the rest was just their knowledge of price. It's actually quite interesting to watch. So we're going to talk about a 30% retracement trading strategy. Okay, now trading retracements, it's very popular for swing traders. And all retrace is where you see a portion of the prior swing move taken out by a retreating of the price action. So the question always comes up with, though, is how much of a price retracement is enough? If you have too shallow of a retracement, you could simply be looking at a trading range. And if it's too deep of a retracement, you might look at the current end of a trend. And what traders usually do is they'll look for an objective level. They'll use moving averages or they use Fibonacci. Other traders will look for former swing highs or lows to target. And others will just look for previous price ranges for price to pull back into. And whatever method you're going to use, there's one important variable that you have to consider, and that is the strength of the prior move. So when looking to trade from a retracement in price, we want to make sure that that prior leg shows intent in the direction. Okay, we're going to get to that. But first, let's talk about the 30% retracement. Now, if we use the more common 50%, now this is not a Fibonacci ratio, it's just 50% of the other move, we're probably going to lose a lot of opportunities, especially when the market is in a strong uptrend. When you use a 30% retracement, it's going to allow you to participate in strong trends off of simple corrections, which is just one leg down. It's going to give you some room to manage a trade before the previous swing high or swing low comes into play. And it's actually going to give you an area to watch for the formation of a complex correction, right? So a two-legged pullback. So just keep in mind, this is a zone where we start to look for trades, okay? We don't automatically just jump into a trade. And this here is a daily stock chart of JMIA. Let's look through this here. At number one, we got a strong upward move in price. Now I'm using the Fibonacci tool just to measure out 30%, okay? So we pull a 30% retracement here at number one from the pivot low to high. And number two, price actually gapped down at least 30% of the prior move. So then we're going to start looking for a trade entry. And number three, that's an outside candlestick pattern. And traders generally would buy off the high of that candlestick. If you zoom down to a short time frame, right, this is a 30-minute chart. This is what we see. Number one, price pulls into the zone. We have a reversal kind of candlestick right off the lows. And there is former resistance acting as support to the left off the chart. You just can't see it. And this will run $3 to the upside before turning around. So that's $3 per share. And number two, it's an obvious reversal candlestick. We buy stop the high, or you can enter on the next opening. And price actually just filled a gap off to the left of the chart. And again, it's not on this particular chart. You can bring up your charts, you'll see it. And the 30% retracement, what it does, it gives you an objective area on the chart to look for. So the question again is, what swing points are we going to use? Well, markets move in waves. We all know that. And the lower time frames that you trade, the more waves that you have. Nothing's perfect, okay? So let's see if we can just put some rules around what swings to consider. Look at this sequence here. I know it's kind of jumbled up, but we'll break it down. Now, the first A, B equals C in red, that gives us our zone. And it actually looks more like a trading range instead of a pullback. But it does meet our 30% criteria. And traders would have easily found an entry in this trade here. You can see just a small pullback. Now go back to the first A at the bottom left. Now we're going to go all the way to the top of that leg for our B. We would not use the trading range, right? We want to prefer to trade swings. Take those low to highs. This is more of a trading range. Price rips through the 30% at C, and traders will start to look for the first pause to find an entry. Now in this chart, we have two prominent swings that we can use for that final high up on the right. Now the first A to B is the red from the bottom left of the chart all the way to the top right. Now you can see the red C has a reversal candlestick forming, and traders will look to trade off of that. In orange, we're going to take the middle swing, A in orange, to be in orange and gives us an orange C. Now, traders may have found an entry on a lower time frame on that trade. Whether it worked out or not depends on how low you go, but it doesn't look like it would. What about the strength of a pullback? Now, one thing I talk about a lot whenever I talk about pullbacks is the strength of the pullback. We don't want to see a lot of momentum, right? We want to see low momentum pullbacks. That shows, in the case of an uptrend, for example, there's not a whole lot of sellers, and they're more interested in holding as opposed to unloadings. So we don't want to see something like this. When the pullback has momentum, not only do you see sellers, right? But think of what visually it means to potential buyers. So after a big move down like this, I would prefer to see a price range before considering a trade in the opposite direction. And traders may also decide, for their own rules, that anything more than a 30 to 50% retracement in price is far too far. And it just shows lack of overall strength for an uptrend. Now, there are a few ways to have an entry trigger. We need those, including a chart pattern and even something I call the reverse 30. As an example, this is a daily stock chart. We're going to look at an alternate trade trigger. So number one, this is the beginning of this leg up, and after a month, it reaches its high. So we're going to measure the distance between 1 and 2. The red line is a 30% pullback off of the high of 2, and the momentum into lows should be considered an exhaustion, right? We don't want to see those big candlesticks right at the top, but when you see them as the move is going down, we face what we call exhaustion risk. And number 4, we don't have an immediate reversal, but we did get a few days of sideways movement, a range, which confirms that the momentum candle at the end was more of an exhaustion than a weakness move. And number 5, we find an objective trade entry by measuring from the high of 2 to the low of 4, which gives us that green line. That's the reverse 30. We could use that price to trigger ourselves into the trade. We need stops. When you set stops, you got to take into account your risk protocols. And so oftentimes your trading is limited by your account size. So you adjust your position sizing when it's appropriate to give yourself a stop loss that makes sense. Okay, so but the question is, what makes sense? A lot of traders will place their stop just under swing lows or above swing highs. But if you don't add a buffer, you run the risk of being popped out due to price discovery. You could consider using a percentage of your ATR reading for the buffer zone. Now, talking of the ATR, it's actually my favorite way to place stops. I start generally with a 1 times ATR, and I see if that gets me under or over a swing point. So if we're using the reverse 30 method to enter our trade here, that means we're going to have short-term momentum in our favor because price has to go that way. So I don't mind having a slightly closer stop since price, when you trigger into the trade, is actually moving away from the stop. Profit targets, there are a number of ways to take profits, and I have a whole ton of videos on that. However, this would not be complete without a place to start, so let's keep that simple as well. Let's take off profits according to our risk. So what does that look like if we use that last example of the chart? All we're doing is scaling out a percentage, usually 33%, right? So a third, when price moves the same distance as our risk. So as price continues up, we would then scale out at 2R and 3 times our risk if price goes that far. So in our example here, price didn't make it to our second target, so it didn't make our 2R. So I would consider exiting the trade when price comes back to the first target, or if it travels at least halfway to the 2R. Let's wrap this up. What I like about it is it does take advantage of the waves in market action. And we're only looking for trades when that first leg of the move is strong. So that can set us up for a continuation trade. If price retraces too strongly, right? Look at the size of the candlesticks will tell you that. You may not trade the instrument, or you might need to see some type of consolidation pattern. So why 30%, not 50 or 70? Well, we want to make sure that we're looking at markets that are strong. So generally, the deeper the pullback in an uptrend, the weaker the market is. Although those trades, if you do get in them, could at least get you into the former high. Now, new traders who are learning price action and what reversals look like, may decide to use the main swings on the chart, the bigger swings. When you look for smaller dips, that can oftentimes give you too many decision points on the chart. Anyways, thanks for watching. Any questions, comments, pop them below. Hit subscribe, like this video, and we'll talk.